Welcome to the deep dive. Today we're digging into VICI Properties, a real giant in experiential real estate.
That's right. We've got their Q3 2025 results, the earnings call info, strategy memos.
And our mission really is twofold. First, understand how their core model, that triple net lease setup, keeps delivering stable returns. And second, figure out where they're looking to put capital next. They seem to be eyeing some totally new markets.
Yeah, and this is, it's pretty crucial if you're following capital markets. VCI, they own these huge assets, think Vegas resorts, leased back to operators.
Right.
It's usually seen as just a stable income generator.
Right.
But these Q3 results, they show VCI isn't just like sitting back.
No, they're active.
Very active. They're using that stability to make some really calculated moves into, well, non-traditional areas.
Yeah.
It makes their story way more complex than just a standard REIT narrative.
Exactly. So we'll go from the nitty-gritty financials for Q3 through the health of their main gaming portfolio,
Right.
and then jump into this emerging focus, things like university sports facilities. Sounds interesting.
It is.
Okay, let's start with the money. Section 1, the Q3 financial snapshot. So even with what they called continuing uncertainty in the environment, VECI delivered.
They really did.
Adjusted funds from operations, AFFO, hit $0.60 per share for the quarter.
Yep, and that's up 5.3% compared to Q3 last year, 2024.
That's not a small jump. And they seem to be saying this growth isn't just luck, it's proof the model is resourceful, right?
Absolutely. It really shows the strength of having those built-in rent increases, inflation protection in those super long leases.
Yeah.
And you see that confidence in their guidance, too. They actually bumped up the low end of their 2025 AFFO guidance slightly.
Okay.
So the range is now $2.36 to $2.37 per share. The midpoint there still points to a very healthy 4.6% growth year over year.
And the dividend. Always important for income folks.
They didn't disappoint, declared $0.45 per share. That's their 8th year in a row increasing the dividend.
Wow, 8th year.
Yeah, a 4% bump from the last one. Consistency like that, well, it's kind of the signature of this triple net model.
But the efficiency just jumps out. Margins in the high 90s if you pull out non-cash stuff.
It's remarkable. And their overhead, the G&A costs,
Tiny.
just $16.3 million for the quarter. That's only, what, 1.6% of total revenues? They run incredibly lean.
That low overhead must be key. Frees up cash.
It's critical. Lets them focus on the big strategic deals.
Yeah.
But, okay, stable income is one thing. We also need to look at risk.
Right.
They track this non-cash thing called the allowance for credit losses, or CECL.
Okay, CECL.
And what's interesting in Q3 is that this allowance actually went down by about $20 million.
Okay, walk us through that. If the allowance goes down, what's that telling us in simple terms? Less worry.
Exactly. It means basically they're less concerned about their tenants running into trouble right now. The main reason was that the stock market performance of their tenants became less volatile. It's kind of a complex indicator, yeah.
Yeah, sounds like it.
But it gives you a running score on tenant risk.
Yeah.
And that score improved, even though VCI did mention the overall economic forecast wasn't super positive.
So the market seems okay with their big tenants, and VCI is watching closely.
Precisely. Very active risk monitoring. Okay, so let's connect that confidence and efficiency to their balance sheet. VCI talks a lot about disciplined capital allocation.
Right, that's their mantra.
They focus on investment quality, long-term growth. They explicitly say they won't compromise creditworthiness to reach for return. It's about building resilience.
Like a fortress, yeah, to handle economic shocks.
That's the idea. And it looks pretty well stocked. Total debt is $17.1 billion.
Which sounds huge, but you got to look at the leverage, right?
Yeah.
Net debt to EBITDA is 5x.
Exactly, 5 times. And that's actually at the low end of their own target range, which is 5.0x to 5.5x.
So 5x is low for them. What does that mean practically? Are they ready to pounce on a big deal, or are they holding back?
It means they have a ton of flexibility right now. Lots of dry powder. Combine that low leverage with their liquidity position. $3.1 billion available. That's over $500 million in cash, plus almost $2.4 billion still available on their credit line.
So they're definitely positioned to be opportunistic.
Absolutely. They don't need to do a deal, but they can if the right one appears. That gives them bargaining power.
Makes sense. And the portfolio generating all this? 93 assets.
Yep. 54 gaming, 39 other experiential ones across 26 states in Canada, and it's 100% leased.
Fully leased. Nice.
But the really stabilizing number is the lease term. Weighted average lease term, 40 years, including renewals.
40 years? years. That's incredible.
That changes everything, right? They're basically pricing risk over economic cycles 4 decades out. That's different from how you'd normally think about tenant credit today.
Still, you can't ignore the concentration. MGM and Caesars are huge chunks of the rent roll.
About 38% and 36% respectively, yeah.
That's a lot riding on two names.
It is. It's just the reality of this specific sector. But VCI builds in protection. Well, for example, the Caesars leases force Caesars to spend a minimum amount on CapEx each year.
Oh, interesting. Like maintaining the properties.
Exactly. There's a $107.5 million floor on annual capital spending for certain properties in the Caesars leases.
So VCI isn't just hoping the buildings stay nice. They have a contract forcing the tenant to reinvest. That protects VCI's asset value long term.
It's very shrewd. Protects against tenant neglect.
Okay, let's look at how they use that stability strategically. The Northfield Park deal, which actually happened after Q3 ended.
Right. This wasn't just collecting rent. VCI played a key role.
Explain that. It involved MGM selling the operations.
Yeah, MGM sold the operations of MGM Northfield Park. But VCI wasn't passive. They signed a brand new triple net lease directly with the buyer, a firm called Clairvest.
Clairvest, that's a new tenant for VCI.
Tenant number 14 for them. And here's the clever part. They amended the main MGM lease to reduce MGM's rent by the exact same amount as the new Clairvest rent, around $53 million a year.
Wait, so the total rent VCI collects didn't change?
Not one penny. They helped facilitate the deal between MGM and Clairvest.
Added Clairvest, who sounds like a solid operator with lots of gaming experience.
Yep, 37 assets globally.
And diversified their tenant base, all without losing any revenue.
That's it. It shows they're not just landlords, they're strategic capital partners in this space, enabling deals, managing risk, staying revenue neutral. Pretty smart.
Very smart. Okay, now we have to touch on the recent noise around Las Vegas. The market got a bit jittery about gaming operators, the REITs too. Short-term slowdown in visitors. Management mentioned idiosyncratic headwinds.
Yeah, they pointed to specific things like less travel from Canada and Spirit Airlines cutting some capacity, things impacting short-term numbers.
But is blaming Canadians and Spirit maybe downplaying broader worries? What's the real risk picture there?
Well, it's certainly a management narrative to calm investors, right? But VCI's actions seem to back up their long-term view.
How so?
They said there's a big believer in Las Vegas long-term, and they're putting money where their mouth is.
Like that new development loan in California?
Exactly. They committed $510 million through a delayed draw loan for the North Fork Casino and Resort near Madera.
And that's not opening soon, is it?
No, not until the second half of 2026. So making huge long-term bets like that signals they aren't really spooked by short-term bumps. They're focused on future asset quality.
Okay, let's shift to the future then. VCI keeps talking about expanding into the experiential dimensions of BALM.
Red BALM. Gaming, hospitality, wellness, entertainment, and leisure.
That acronym seems important.
It is. It signals they're thinking beyond just casinos and hotels. It's a broader leisure infrastructure idea.
And the area getting the most buzz right now seems to be university sports infrastructure.
Yeah, they called that sector undergoing radical change.
Which makes sense with all the NIL stuff and conference shifts. So where does VCI fit in with arenas, stadiums, practice fields?
Well, think of it like this. Colleges are in an arms race for the best facilities to attract athletes and fans. They need billions for upgrades or new builds, stuff that lasts decades. But getting that kind of long-term financing can be tough, especially for public universities sometimes.
And VCI can offer that long-term money.
That's their edge. They talk about their perpetual capital. Compare that to typical private equity, which might want an exit in, 5 or 7 years?
Yeah, that doesn't work for a stadium meant to last 40 or 50 years.
Exactly. VCI's long-duration capital is a much better match for what these universities actually need.
But it must be incredibly complicated, dealing with state rules, public finance, land ownership.
Oh, massively complex. And VCI knows they're kind of paving the way here.
So they're still figuring out the details.
Yeah, talks are ongoing. How do you structure it? Is it a leasehold? Can VCI own the land? What kind of long-term lease works under state law? They're navigating a huge, untapped market with massive, immediate capital needs.
Really feeling their way into it. Are they looking at other areas, too, besides sports?
Yes. Actively studying other experiential things. They mentioned attractions, maybe like theme parks, referencing news about Six Flags.
Okay.
The tricky part there, and in other new sectors, is the diligence. They need to figure out how much is actual real property land and buildings That fits the rate rules.
as opposed to personal property like the rides themselves.
Right. How much of the business value is in stuff that's readable as real estate for REIT purposes versus, the roller coasters or specialized equipment? It's a key distinction for them. #outro.
Okay, so let's wrap this up. VCI's Q3 story seems to be this powerful two-track strategy. On one hand, really disciplined financial management of the core business. You see that in the AFFO growth, that clever Northfield deal, keeping revenue flat while diversifying.
Right, maintaining the fortress.
And then track two is this very focused long-term search for new types of assets in these non-traditional experiential categories.
Yeah, and the key takeaway, I think, is how that core stability, the triple net leases, provides the patient capital they need to even attempt these new, high-cost, long-duration sectors.
Right.
They're using their position as a low-cost capital provider to basically try and shape how future leisure and entertainment infrastructure gets funded.
It's ambitious. So here's something for you, the listener, to think about. Given this huge shift in college sports, the radical change they mention, and the billions universities need for facilities, what does it mean if long-term real estate partnerships, like the kind VCI might offer, become common? Could it fundamentally change how college sports facilities are owned and funded? Think about it. A 40-year lease on a stadium outlasts coaches, presidents, entire generations of players.
That's the kind of timescale VCI is built for.
Exactly. Something to ponder.